As we head into 2022, one of the biggest challenges portfolio managers are facing is what do you do with the 40%, the risk management sleeve of the portfolio. And putting the threat of rising rates aside, current yields are making it difficult to meet portfolio return expectations and appropriately hedge risk. If you look over the last 40 years, starting yield has explained over 95% of the total return of the Bloomberg Barclays Aggregate Bond Index, with very little deviation one way or the other. So with the current yield on the ag right around 2%, producing a positive real return from a core bond position could be difficult. The other challenge that we see is that yields may be too low to effectively hedge equity market risk. If you think about one of the reasons why bonds have provided the protection that they have, as nerves kick up in the market, investors pile into bonds for safety, pushing down yields and lifting prices. The issue now is that yields are so low, there's less room for them to fall, and because of that, potentially less protection. So with all this in mind, we really believe investors may need to look outside of the traditional 60-40 framework to manage risk and return characteristics. In contrast to bonds, defined outcome ETFs seek to offer the upside of an equity-based reference asset to a cap with a predetermined buffer against losses. As an example, BALT, the Innovator Defined Wealth Shield ETF, seeks to offer exposure to SPY with a 20% buffer against losses each quarter. Since inception, BALT has shown an average quarterly outcome period cap of 86 basis points. So right now, we really believe risk management strategies like BALT can be powerful tools for portfolio construction, giving investors the ability to manage risk while increasing their overall exposure to equities. At the end of this video, we'll discuss important characteristics of bonds and buffer ETFs.
Defined outcome ETFs carry equity risk, which has historically been greater than bond risk. In order for defined outcome ETFs to produce a positive return, equity prices must rise. If equities fall more than the predetermined buffer, investors risk a loss. Unlike bonds, defined outcome ETFs cannot rise when equities fall. The returns of defined outcome ETFs are based on the reference asset's price return rather than its total return, which includes investment income such as dividends. By investing in defined outcome ETFs, an investor is foregoing the dividend return stream of the equity-based reference asset.
The fund's investment objectives, risks, charges, and expenses should be considered carefully before investing. The prospectus contains this and other important information, and it may be obtained at innovatoretfs.com. Read it carefully before investing.